Good day, everyone, and welcome to our webinar for July 2025. We begin, of course, in America, as we usually do. The S&P 500, which you can see displayed here on your screen, made a new record high last Friday at 6173 and has subsequently gone up to 6204. This is more or less in line with what we predicted. And it concludes the Trump tariff correction, which you see on your screen here, which began there at the previous record high on the 19th of February and took us down to this low here at 4982 on the 8th of April. As we expected, the correction took the form of a V bottom. This type of correction comes from an extraneous, what we call a black swan event in the market. It's very similar to what happened with COVID-19 back in 2020, which also resulted in a very similar V bottom. In other words, if an event is not part of the normal cycle of economic factors and comes from an extraneous area, then of course we have to look at what the shape of the chart is going to be like. And it's normally a V bottom. We actually predicted that it would be a V bottom a little while ago. Of course, during a time like this, investors are temporarily distracted from the underlying forces which are driving the market. So for this 4-month period, from the previous high until we broke again last Friday, investors have been distracted from the factors which have been driving the market, which are basically the new technologies which are adding to productivity across the board. But this does not mean that those forces cease to operate. AI, humanoid robotics, and advances in solar power did not stop because Trump decided to impose some tariffs, which he's now, of course, backed down on substantially. And once the event, whatever it is over, the market must then do some catching up, and that is where we are now. Wall Street is busy catching up. Trump has delayed the uptrend by maybe 4 months. The S&P is being driven higher by high-tech companies like Nvidia. That share has risen by 67% since its low point on the 4th of April 2025. Now that the correction is over, the S&P should move steadily higher. You should watch out, however, for a mini correction after a few days or weeks, which will take the S&P back down to the 6144 resistance level, which now becomes, of course, a support level. This is normal technical analysis. Other world markets, including the JSE, will follow Wall Street up. All right, let's look at the economy, the American economy. The economy created 139,000 new jobs in May. This is above the forecast of 125,000 made by economists, but below April's 147,000 new jobs. And it shows that the economy is still growing despite the relatively high level of interest rates and Trump's tariffs. It's more evidence, in fact, that the Fed has achieved its goal of a soft landing for the American economy. The strong jobs figure took the S&P 500 back above the key 6,000 level, and both the CPI and core CPI were slightly lower in May, and that gave investors confidence that Trump's tariffs are not impacting on inflation, at least not yet. Of course, the tension between Trump and the Fed continues and looks like it's escalating. Jerome Powell's contract as governor of the Federal Reserve Bank ends in 2026, and the Monetary Policy Committee decided to keep rates unchanged in their most recent meeting, but they reduced their growth forecast. They now expect the U.S. economy to grow by 1.4% in 2025, and that's down from 1.8%. Inflation is also expected to rise slightly to about 3%. Of course, the oil price rise following the Israel-Iran conflict has been a major problem. But that problem appears to be subsiding now, and oil has fallen back down again. We'll talk more about oil later in the presentation. The S&P 500 company results, especially in the high-tech area, have been consistently good. For example, Oracle's results, which were published on the 11th of June, saw the share price rise by 13%. The Oracle CEO said cloud infrastructure revenue should increase by 70% in 2026 alone. It's interesting that Koos Becker, who's the CEO of Naspers, said that AI will have the same impact on productivity worldwide as the invention of the steam engine and the railways. That's an amazing statement. It shows that we're just at the beginning of this AI revolution, and that productivity amongst companies all over the world will be benefited. In other words, AI is only just beginning. All right, at the same time that all this has been going on over the last month, of course, there's been a considerable rise in the geopolitical risks in the world. The Ukraine war is still going on. Russia and Ukraine have been engaged in talks in Istanbul, but that has been described even in the Russian newspapers as the theater of the absurd. Both sides have submitted memorandums for what they want in order to achieve peace, and those two memorandums are worlds apart. Russia is not really interested in peace because that could result in Putin's overthrow. The destruction of 41 Russian aircraft by Ukraine costs Russia $7 billion, and it demonstrates Ukraine's ability to strike anywhere in Russia. It also shows Ukraine's growing technical superiority. And that must be contrasted, of course, with the fact that Russia is now using donkeys to take ammunition to the front lines. The war seems to have reached a stalemate. Neither side can advance. On Friday, it was 3 years and 124 days since the war began. On that day, Russia launched 363 drones and 8 missiles against Ukraine. Of those, 359 drones and 6 missiles were shot down by Ukraine, but obviously the balance got through and caused injuries and deaths. It's also apparent that Russia's spring offensive, much vaunted, has got bogged down. The Russian economy is also stalling. Foreign holdings have fallen about 50%, and foreign direct investment is down 62.5%. Made worse, of course, by government asset seizures. These asset seizures have seen 12 big companies nationalized in the past 3 years. Car sales are expected to fall by 25% in Russia this year. And obviously Russian consumers are battling. Inflation at 10%, combined with salary cuts and cancelled bonuses, is putting more pressure on them. The oil price remains a major problem. It's now back down close to $60 a barrel again, after the little surge that it went through, and again we'll talk more about that later. Russia's $2.8 trillion economy is beginning to collapse. The central bank did cut interest rates by 1%, but that takes them down to 20%, which is still extremely high. Donald Trump, of course, must give up on getting the Nobel Peace Prize for sorting out the situation between Ukraine and Russia. I think that's a major source of difficulty for him. And he now appears to be focused on the Middle East and Israel's war with Iran. Iran, of course, has been trying to build a nuclear bomb for the last 3 years. And the bombing of Iran's underground nuclear facilities adds to the geopolitical risk in the world. These facilities are definitely not being used for peaceful purposes. Nobody puts a peaceful nuclear power station 80 meters underground. That's just not sensible. So these were clearly for something that was not peaceful, and they have now been destroyed, or at least partially destroyed. Other Arab countries did not come to Iran's aid, and I think that's significant. They, of course, also don't want Iran to have nuclear weapons. The German Chancellor said that Israel had been doing the world's dirty work for it. Initially, when this news was reported, the S&P 500 fell 7%, but it has now recovered. And of course, as you've seen, it's making new record highs. It's notable that Israel's Iron Dome was unable to protect it against the hypersonic missiles launched by Iran. So that's obviously something that they will have to sort out. Okay, coming home to domestic affairs, and on the political front, we've had the firing of Andrew Whitfield by President Ramaphosa, and that is, of course, putting the Government of National Unity at risk. The DA insists that he also should fire those ANC ministers who are accused of corruption. And the DA says that the firing of Whitfield is a calculated assault on them, and it reflects double standards. So that's something going on there. The Free Market Foundation and Solidarity have just produced a report on the cost of BEE to the South African economy. They found that over the last 20 years, BEE has cost South Africa 5 trillion rand, and has also resulted in the loss of at least 4 million jobs. BEE policies are estimated to reduce GDP by between 1% and 3%. 1.5% and 3%. Since 1994, the black middle class in South Africa has grown from 4 million people to 6 million. But it has been at the cost of the poor and the lower income groups. The Black Business Council says the report is nonsense, but Alec Hogg of Business News says it was superbly researched. Operation Vulindlela, which is part of President Ramaphosa's reform process, has been continuing, and it's now turning its attention to the municipalities and the issue of service delivery. Apparently, municipal wages and salaries are up 84% in the time between 2010 and 2024, and this has amounted to a huge increase in costs, and it's absorbed all the surplus funds available to the municipalities, leaving nothing for the maintenance of infrastructure. That in turn has resulted in the collapse of service delivery. And of course, as we know, it's had an impact on the ANC because they lost a lot of votes in the last election, and that led to the formation of the Government of National Unity. Like Eskom, the metros have bloated, inefficient and overpaid staffs. All right, let's look at the economy now. Gross domestic product was flat in the first quarter, growing by just 0.1%. That compares with the fourth quarter of 2024, when we had 0.4% growth. Contractions in mining and manufacturing were offset by agriculture and consumer spending. It's estimated that the growth for the whole of 2025 may now be as little as 1%. And that obviously is a reduction from the Treasury's previous estimate of 1.4%. Nedbank is predicting 1% growth, down from their previous estimate of 1.3%. Structural problems at Transnet's rail and ports remain a problem. The Standard & Poor's rating agency is predicting 1.3% as growth this year, and that's pretty much in line with Moody's and Fitch. We expect growth to surprise to the upside in the rest of the year, and that's mainly because of rising consumer spending, and that's being motivated by the low inflation rate. Trump's tariffs are only expected to have a slight impact on South Africa, affecting about 2% of our gross domestic product. Other than that, take-home pay is looking very good. Spending power is rising. People are earning more in real terms this year than they did last year. Mining production was down 4.1% due to falling commodity prices. Agriculture was up 15.8%. And take-home pay rose 10.7% in real terms, mainly, as I said, due to the low inflation rate. So far this year, salary earners are 1.7% better off in real terms and salary increases have averaged about 5.9% this year. The drop in interest rates and the two-pot system of retirement has helped the economy. It's put more money into the economy. BankServe's Betty Electronic Transactions Index is up 1.4% last year, with both the number of transactions and their average size increasing. Unemployment rose to 32.9% in the first quarter compared to the fourth quarter of last year. The economy lost about 74,000 jobs, mainly at trade and community services. Manufacturing added 2,000 jobs. Year on year, the total number of jobs fell by 0.9%, showing hardly any growth in the economy. The 4-cent increase in the fuel levy will raise about 4 billion rand for the government. It will, of course, impact lower-income groups who spend a high percentage of their income on transport. Capitec CEO Jerry Fauria says that unemployment in South Africa is not at the official level of 32% or 33%, and it's in fact closer to 10%, mainly because of the informal sector. He says millions of people conduct small businesses for cash and pay no tax, and they are not part of the Stats SA record on informal sector. So he's saying that the inflation rate is much lower than the official figure. Mexico has a much larger official informal sector than South Africa and much lower unemployment. He said the government should be encouraging the informal sector because that's where the jobs are being created. The South African Reserve Bank every 3 months produces its quarterly bulletin, and in terms of that bulletin, the latest bulletin, South Africa's gold holdings have doubled in value, mainly of course due to the rise in the gold price since March 2024. In February, the bank transferred 150 billion of this profit on gold to the Treasury to help it bring down its total borrowing. The bulletin also reports that 37 billion flowed into South Africa in the first quarter. Much of this is foreign direct investment and is added to our gold bonanza to boost reserves. That has a positive impact on the rand, and it helps us to reduce inflation. The bank says the South African economy is doing well against geopolitical uncertainty. It is also probable that we will be removed from the grey list in October this year because of the work that's been done to achieve that, and that will obviously also have an impact on foreign direct investment. The trade account continues to show surpluses as exports exceed imports. In the first quarter, the surplus was 221.2 billion. It's a bit less than the fourth quarter of last year, but still running at about 3% of gross domestic product. Of course, the rising gold price has helped a lot. South Africa, however, remains an export-led economy, dependent on mineral exports primarily. Manufacturing continues to be weighed down by high electricity costs. Water shortages and outages in Gauteng have become a factor in recent months. Confidence is still low. Against that, retail sales are up 5.1% in the year to the end of April. Mainly the general dealers, which is obviously the supermarkets, got most of this, and clothing got the rest. The effect of Eskom's price increase and obviously the bracket creep in the budget will be a major factor. New car sales were up 22% from a year ago in May. This is the 8th month that we've had year-on-year gains, and up to 12.6% better this year than in the first 5 months of last year. 12 of the 24 Chinese imported brands are not included in these figures, so the figures are not necessarily totally accurate. Transnet has signed a deal with its unions for a 6% wage increase for the next 3 years. This is, of course, more than double the inflation rate of 2.7%. and comes after Transnet reported a 2.2 billion rand loss in the 6 months to the 30th of September 2024. Transnet has just been given a further 51 billion rand government guarantee. This comes after the 47 billion guarantee which they were given in December 2023 and which has been completely used up. Transnet currently pays about R1 billion a month just in interest on its debt. The wage increase is clearly excessive and, of course, ultimately will be paid by taxpayers. Congestion at Richards Bay has reached critical levels. Tonnages have dropped from 78.5 million tonnes in the 2015-16 year to just 52.6 million tonnes this year. Long queues of trucks are waiting to offload. Exporters have moved away from rail transport because of its inefficiencies, but now the road system is clogged up. The government is trying to get the private sector involved to improve efficiency. The problem is a major problem for this country, and it's strangling our mineral exports, which is a huge matter. The N2, our highway, the N2, was designed for 200 trucks a day and is currently carrying about 2,500 trucks a day. Okay, a couple of general points now. South African Revenue Services was allocated an extra 7.5 billion rand over the next 3 years in the budget. This will enable them to employ 1,700 more debt collectors. And that is over and above the 750 that they appointed last year. SARS says that this will enable them to collect an extra 20 billion rand in tax revenue next year. The second point I want to make under this heading is that Letsetja Kanyago is arguing strongly for the target inflation rate to be reduced to 3%. Obviously, that is quite a big difference from the range that we had before of between 3 and 6%. But he says that this will save the government about 870 billion rand in interest over the next 10 years. Right now, the government pays 386 billion rand a year just in interest on its debt. The debt is about 5.7 trillion rand, or 5%, 5.2% of GDP. About 1 rand in 5, which is collected by SARS as tax, is used just to pay the interest on the government debt. Obviously, also, if the target inflation is brought down, it will reduce inflation, and that will be then in a similar region to our trading partners. The CPI is currently below 3% due to the strength of the rand, and that has been assisted by the falling oil price and has brought fuel prices down in this country. All right, let's talk a little bit about the rand. I just want to put the chart up on the screen here. Okay, as you can see here, this is the rand. You can see it's been strengthening quite significantly. When this chart is falling, it shows the rand is strengthening. You can see that with Trump's tariffs and his Liberation Day and the 25% tariff on vehicles imports, the South African rand reached a high level of 1993 to the US dollar just a little while ago on the 9th of April. That's because these tariffs caused a major switch towards risk on, and investors dumped emerging market assets, and particularly in this country, and that caused the rand to weaken substantially. But since Trump started to back down on his tariffs, and things have been improving and the rand has been strengthening steadily, you can see there's a resistance level here at 1880, and the rand has broken down through that. And yesterday the market closed with the rand at 1762, which is quite a big difference. So we're definitely back into an area of risk off, and investors are buying emerging market assets because the rate of return on them is just better. So we expect the rand to continue strengthening, especially if the ANC and the DA can settle their differences over Andrew Whitfield. All right, let's talk a little bit about commodities. I'd like to begin with the oil price. I have mentioned oil earlier in the presentation, but here's the chart. I just want to put a bit more data on the screen here. Okay, there you got the chart over the last 2 years of North Sea Brent oil. As you can see from the chart, there's a support level. There was a support level here at 72, but the upper trend line is a downward trend line with descending tops, and you'll notice that the oil price went up and touched that trend line the other day on the 12th of June at $78, and then fell straight back down again. So it's now trading for about $67 a barrel. It's interesting that this chart shows the importance of a trend line like this with consecutive touch points. It enables you to see just how far a particular chart is going to go. You'll notice that now there's a new support level down here at $60 a barrel. Obviously, the break below 72 is not good news for Russia, but it is good news for everybody else, because everybody else is experiencing a lower cost of fuel throughout the world. But Putin is not enjoying it because it means less money to fight the war. All right, let's look at gold now. We do mention gold quite often because, sorry, I didn't get that right. There it is. Okay. The World Gold Council is now saying that it expects the gold price to continue going up this year. I'm just going to put a bit more data on here. Let's go back out to that. Now you can see here the upward trend in gold since it broke above the 2060 resistance level here in March 2024. We reported on that in the confidential report in March 2024. And you can see after that we've had a strong upward trend, and gold appears now to once again have reached a resistance level here at 3424 in this area here. But we expect that in due course it will probably break above that level. Obviously, gold is the ultimate asset. It's the most secure asset you can buy, and it has a zero return. So it doesn't pay any interest, any dividends, or any rent. It doesn't add 10% to its weight every year. It has a zero return. The only reason why investors are buying gold is for security. There is no other reason. But obviously there has been some profit taking, and we expect the gold price to maybe pull back a little bit now to somewhere around $3,000 an ounce. But in due course we expect it to continue going up. It has always responded well to geopolitical risk because it is the ultimate safe haven investment. All right, now platinum is a slightly different story. The platinum price has been falling since the subprime crisis of 2008. So I want to put that data on the screen here. Even going to put on more data just to show you the long-term situation with platinum. Put the whole thing on. All right, so there you've got it. Sorry, that's a bit too much, but you can see the subprime crisis. Platinum was rising strongly in 2007, and the subprime crisis of 2008 took it right down, and since then it's been in a long-term downward trend. Here you can see COVID-19 caused it to spike down, but recently there's been a strong upside break here, and this is what I want to draw your attention to. It's similar to the upside break that we saw on gold, and platinum has really risen sharply, and that has had an impact obviously on our platinum mines, and it will have an impact across the board. South Africa produces about 80% of the world's platinum, so this will benefit our economy and has already had an impact on certain shares, which we'll talk about just now. The last commodity that I want to mention is iron. Iron ore prices fell below $100 a ton recently due to weak Chinese demand. The Chinese are not buying as much iron ore as they used to. Obviously, Trump's tariffs are also restricting the demand for the metal. Chinese steel production has been falling because of their shrinking construction sector. In the first quarter of 2025, Kumba sold 9 million tons of iron ore at about 11% above the benchmark price. But there are major problems with Transnet, although Kumba says the rail performance has improved slightly. The international iron ore market remains extremely competitive. We do not expect the price of iron ore to recover anytime soon. Okay, let's turn our attention to some companies now. I'd like to begin by just talking about OUTsurance. OUTsurance is obviously what remains of Rand Merchant Investment Holdings after the unbundling or sale of Discovery, Momet and Hastings and others. So all that's left now is OUTsurance, and the name has been changed to OUTsurance. So now this is a company involved in insurance businesses in South Africa, in Ireland and in Australia. In the results for the 6 months to the 31st of December 2024, gross written premiums were up 17.4% and new business written was increased by 17.9%. So this is a solid blue chip share which is growing steadily. As you can see from the chart, there's a long-term upward trend here. We added it to the winning shares list on the 14th of June 2024 at 4457 cents, and it's since risen by 78.2%. So that's in just over half a year. Technically, the upward trend is very strong, but there is some volatility. The share is on a PE of 29.3, which means it's expensive, but we believe that it should be bought on any weakness. Okay, let's talk about Northam, which is one of those platinum mines that we've been discussing here, and it's benefited from the rising platinum price, as you can see from the chart here. Put a bit more data on. You can see that Northam was in a long-term downward trend, and that downward trend came to an end in April and May this year. And it's been added to the winning shares list on the 23rd of May, and it was then at a price of 143.11 cents, 143 Rand and 11 cents. Since then, it's gone up quite strongly to 192 Rand, which is a gain of about 34% in just over a month. We expect this upward trend to continue. But of course, you mustn't forget that this remains a commodity share and is therefore quite risky and potentially volatile. Okay, now I'd like to talk about Premier. Premier is a food company which was spun out of Brait. There was an initial public offer on the 24th of March 2023. And at first, the share didn't do that well. But it moved basically sideways, but it started to move up quite nicely in July and August last year. And in its results for the year to the 31st of March 2025, revenue was up 7% and headline earnings per share were up 26.8%. Food producers do not usually make exciting investments, but Premier has been doing well since it broke up out of its sideways market in September 2024. And it certainly has begun to attract some institutional interest. We added it to the winning shares list on the 21st of August last year at 76.35. It subsequently has moved up to 141.51 cents, 141.51 cents. That's a gain of 84.68% in 10 months. And again, we think that this share will continue to perform well. Naspers, obviously a very big company, international company. The primary problem with this company is it's got a share structure which incorporates N shares. The N shares have a very small voting power. In fact, the A ordinary shares have 1,000 times as much voting power as an N share. They rank exactly the same in all other respects, but they have 1,000 times more voting power. This structure is frowned upon by the international investment community, and that tends to cause Naspers to trade at a discount to its real value. The major asset of this company remains its 26% stake in the Chinese gaming company Tencent. The risk, of course, there is that the Chinese authorities are always seeking to regulate gaming, but over the years Tencent has been a remarkable success story. Naspers' share price has always been a bit depressed, though, because of its capital structure. If you look at the chart here, you can see that we added it to the winning shares list on the 15th of February 2025 at 4,600 Rand a share. It subsequently has risen to 5,510 Rand, a gain of nearly 20% in 4 months. We believe it will continue to perform because Koos Becker, who's the CEO of Naspers, is always trying to find ways to unlock value into shareholders' hands. And then the final share I want to talk about is Pan-African. We have spoken a lot about this share in the past. This is obviously a gold mining company which is involved in the retreatment of mine dumps. So let's put a bit more data on the screen there. You can see the chart for the last 2 years. As a retreatment operation, it does not have the risks of an underground gold mining operation. So it doesn't have, faulting and friability of rock and flooding and all those things that affect normal underground mines. Its grade is absolutely known. The grade is, of course, very small, but it's a surface operation, so the costs are also low. So this company has actually become quite a heavyweight gold producer. In the operational update for the year to the 30th of June, the company said that production was up 6%, but gold production was up 32% in the second half of the year. This has resulted in massive cash flows because of the rising gold price as well, and the company has been able to cut its debt by 1/3. We added it to the winning shares list over here on the 31st of January last year at 430 cents. It's now trading for 1,125 cents, which is nearly triple. So it's nearly tripled this share over the, 18 months or so that we've had it on the winning shares list. All right, folks, that's about all that I have for you today. I hope that you did find something in all this that is of value to you. I would urge you to follow us on Twitter. The link is in the description below this tube. So go and have a look at that and follow us on Twitter, because I do put up comments there every now and then about what's happening on the world market. Otherwise, thank you very much for listening to me, and I'll talk to you again on the first Wednesday in August. Thank you.